Hello friends, welcome back. Today we are going to summarize Chapter 9 from Money Smart, the essential education for financial freedom. Chapter 9 is all about credit confidence. Now if you've been following along, you know that this book is incredibly comprehensive when it comes to personal finance. So let's dive into what this chapter has in store for us. Chapter 9 focuses on demystifying credit and helping readers understand how it truly works. Why is a strong credit score so crucial? How can you improve your credit? What are some common credit mistakes that you should avoid? We're going to answer these questions and more as we work through this chapter summary. So why is having a good credit score so important? Well, having a great credit score isn't just about being approved for a mortgage. It opens doors to a multitude of financial opportunities. Lenders use credit scores to assess the likelihood of you repaying borrowed money. A higher score translates into lower interest rates, saving you thousands over the life of a loan. Besides mortgages, a good credit score can help you secure better interest rates on credit cards, personal loans, car loans, and even student loans. In today's world, a solid credit profile is often a prerequisite for renting a home or even getting a job. By understanding and improving your credit score, you're not just building financial trust, you're paving the way for a better future. Let's look at what goes into your credit score. Your payment history. 35% of your credit score is the most significant factor influencing your creditworthiness. This includes your track record of paying bills on time for all types of credit cards, installment loans, finance company accounts, retail accounts, and mortgage or rent payments. The secret here is to pay all your bills on time, every time. Credit utilization. 30% of your credit score refers to the percentage of your total available credit that you're currently using. For example, if you have a credit limit of $1, $0, and a balance of $200, your utilization rate is 20%. The lower the better. Keeping your credit utilization low demonstrates that you can manage your credit responsibly, which in turn boosts your credit score. Credit history length. 15% of your credit score takes into account the age of your credit accounts and the length of your credit history. The longer your history, the more established your credit profile becomes, which generally leads to a higher score. However, if you don't have much credit history because you haven't had the need or opportunity to borrow in the past, don't worry. As you start building credit and make on-time payments, your score will gradually improve. Credit mix. 10% of your credit score considers the different types of credit you have, including credit cards, installment loans, such as car loans and mortgage loans. Having a mix shows that you can handle various credit products responsibly, which contributes to a better score. Don't feel pressure to take on debt just for the sake of building a credit mix. Only do so if it aligns with your financial goals and you can manage the debt responsibly. New credit inquiries. 10% of your credit score reflect the number of times you've applied for new credit in a recent period. Each time you apply for a new account, the lender will perform a hard inquiry or a hard pull on your credit report. These inquiries can temporarily lower your credit score. However, the impact is usually minor, especially if you're doing it for a good reason, such as getting a mortgage or a credit card with great rewards. In addition to understanding the components of a credit score, it's also essential to be aware of common credit mistakes that can negatively impact your score. Maxing out your credit cards can be a significant misstep. When you use a large portion of your available credit, it can signal to lenders that you may be overextended and struggling to manage your finances, leading to a lower credit score. Similarly, closing old accounts can be detrimental as the age of your accounts contributes to your credit history length, a vital component of your score. Avoid making this mistake unless you have a compelling reason, such as an inactive card with an annual fee. Safeguarding your credit is paramount to prevent identity theft and financial fraud. Regularly check your credit reports for errors or signs of suspicious activity. You can obtain a free copy of your credit report from each major credit bureau annually through the Fair Credit Reporting Act. By staying vigilant and proactive, you can protect your credit and maintain your financial well-being. And there you have it, a summary of Chapter 9 from Money Smart, the essential education for financial freedom, by demystifying credit and equipping you with the knowledge to build, protect, and maintain a strong credit profile. You're empowered to navigate the financial world with confidence, secure better opportunities, and pave the way for a brighter financial future. Thank you for joining me on this journey through financial literacy. If you found this summary helpful, give this video a thumbs up and subscribe to our channel for more. Until next time, keep learning, keep growing, and keep mastering your money.